Welcome to the deep dive. Today, we're zeroing in on the latest financials from Deckers brands.
Right.
You know the names UGG, Hoka, those big ones.
Yeah, definitely.
And you're probably here because you want the real story, the key takeaways from the numbers, without, wading through pages of jargon.
And that's exactly the plan.
Yeah.
Our mission, if you will, is to pull out the most important, the most interesting bits from Decker's full fiscal year 2025 report.
And their early look at Q1 for fiscal 2026 too, right?
Exactly. We'll be looking right at their official earnings release, focusing on those key indicators, the KPIs that really signal where the company's actually heading.
Okay, let's get into it then. Fiscal year 2025, the overall picture, and wow, what a picture. Deckers hit a record $4.99 billion in revenue.
Almost $5 billion, yeah. A really solid 16% jump year over year. That's significant.
It really is. What was driving that? I mean, was it just more shoes sold or something deeper?
Well, it's a bit of both, but it really speaks to the strength of their main brands, Hoka and UGG particularly. They've both been strategically building their presence, appealing to a pretty wide audience. That momentum is key.
And the profit side looked good too. They had a record for diluted earnings per share, EPS. That was $6.33.
Up 30%.
Which is huge.
Yeah, 30% increase.
Yeah.
Just as a quick reminder for everyone, EPS basically tells you how much profit they made for each share of stock out there. So a record like this, it really says something about their financial health.
Absolutely. It means more of that revenue is actually dropping to the bottom line for shareholders. And speaking of shareholders, they also bumped up their share repurchase authorization. It's now at $2.5 billion.
Okay, share repurchase. So the company is buying back its own stock. Why do they do that? And what's the potential upside for investors?
Good question. So when they buy back shares, it reduces the total number of shares available on the market.
Right.
And that can do a couple of things. First, if profits stay the same or grow, but there are fewer shares, your earnings per share, the EPS, goes up. Makes each share seem more valuable.
And second, it can kind of signal to the market, hey, we think our stock is a good buy, maybe even undervalued. It shows confidence, which can sometimes boost demand for the stock itself.
Makes sense. Confidence signal, potentially better EPS. Got it.
Now, let's break down the brands. We know HOK has been huge,
Yeah.
but what did the numbers actually show?
HOK's performance was, well, pretty stunning, actually. Net sales jumped 24%.
24%.
Yeah, reaching $2.233 billion. It's clearly a massive growth engine for Deckers right now.
Wow.
Probably driven a lot by the running shoes, trail shoes, tapping into that whole fitness and outdoor trend.
Incredible momentum there. Okay, what about UGG, the original big name?
UGG also had really strong growth. Net sales were up 13%, hitting $2.531 billion.
Still huge, then.
Oh, yeah. So even though HRK is growing faster percentage-wise, UGG is still the slightly larger brand by revenue and showing real staying power. It's clearly still connecting with consumers across, its different products. Okay, good to see both powerhouses doing well. Now, they have other brands too, right? Teva, AHNU, Koolaburra. How did that group do?
Right, they now lump those together as other brands. That segment actually saw a decrease in net sales, down 8.6% to $221.2 million.
Okay. So a bit of a dip there.
Yeah, it might suggest maybe a strategic shift, focusing resources more on UGG and HOKA, or maybe just some specific challenges in those markets. It's important context, though, for the whole picture.
Definitely provides balance. Okay, so where did these sales happen? Was it more through stores like Foot Locker or people buying direct from Deckers online?
Growth in both, actually. Wholesale selling to other retailers was up a healthy 17.4%. That's $2.856 billion. Shows strong retail partnerships.
Okay, strong wholesale. And direct, buying straight from UGG or HOKA sites or stores.
Direct-to-consumer, or DTC, also grew nicely, up 14.8% to $2.130 billion.
Pretty balanced then.
Yeah, and there's a key metric within DTC called comparable DTC sales. It looks at sales from channels open both this year and last, kind of filtering out the noise from new stores opening or closing.
Ah, okay, like for like sale.
Exactly. And those comparable DTC sales were up a solid 13.4%. So good organic growth in their own channels, too.
All right, so growth across the board in how they sell. What about where they sell? Was this mostly a U.S. success story, or did international play a big role?
International was actually a standout performer. Domestic sales grew, don't get me wrong, up 11.3% to $3.187 billion, which is great.
Okay.
But international sales, they jumped 26.3%.
Wow, over 26%.
Yeah, hitting $1.799 billion. It really shows their brands are gaining traction globally and their expansion efforts are paying off.
That's really significant international growth. Looks like that strategy is working.
Sure.
Okay, let's switch gears slightly to profitability, the money they actually keep. How did their margins look?
Gross margin improved. It went up to 57.9% from 55.6% the year before.
And gross margin, that's basically revenue minus the direct cost of making the shoes and stuff, right?
Exactly. So a higher percentage means they're either getting better prices or they're becoming more efficient in making or sourcing their products. Or maybe a mix of both. Either way, it's good for profit.
Definitely a positive sign. What about their operating costs, like marketing spend, admin, all that? SG&A?
SG&A expenses, selling, general, and administrative, they did go up, rose to $1.707 billion from $1.458 billion.
Okay, quite a jump there, too.
It is, but it likely reflects them investing more, marketing HOKA and UGG heavily, maybe hiring more people to support the growth, expanding operations. You have to see it alongside that big revenue jump.
Right, you spend money to make money sometimes. So how did that all shake out for their operating income, the profit from the core business?
That saw a really nice increase. Operating income hit $1.179 billion,
Yeah.
up significantly from $927.5 million.
Very strong.
Yeah, it shows that even with those higher SG&A costs, the strong revenue and better gross margin resulted in much healthier core profitability.
Okay, that gives us a great sense of the full fiscal year. Let's maybe zoom in a bit on the most recent quarter, Q4 fiscal 2025. See the latest trends.
A good idea.
Yeah.
So in Q4, net sales growth continued, but it moderated a bit, up 6.5% to $1.022 billion.
Still growth, but slower than the full year's 16%.
Exactly. Could be seasonal, could be a slight cooling off from those really high rates earlier. Something to watch.
And the brands in Q4, did HOKA keep up the pace?
UGG sales were up, but more modestly, 3.6%. HOKA, though, still strong, up 10.0% in the quarter.
Okay, HOKA is still powering ahead.
Yep. And the other brand segment saw a similar dip, down 6.3%, consistent with the full-year trend. So HOKA's continued strength is definitely a key point from Q4.
What about the sales channels in Q4? Any shifts compared to the full year?
Yes, actually a bit of a divergence there. Wholesale stays strong, up 12.3%.
Okay.
But DTC net sales actually dipped slightly in Q4, down 1.2%.
Oh, interesting. That's different from the full year's DTC growth.
It is. It's definitely something to keep an eye on in future quarters, see if that becomes a pattern or if it was just a Q4 blip.
Yeah, worth noting. And geographically in Q4, still strong international.
Very much so.
Okay.
Domestic sales were basically flat in the fourth quarter.
Flat. Okay.
But international sales, still booming, up 19.9%.
Wow. So international really carried the growth in Q4.
It certainly looks that way. And despite the slower overall sales growth in Q4, their diluted EPS still improved. It was $1 for the quarter, up from $0.82 the year before.
So managing profitability well, even with slower top-line growth. Let's look at their balance sheet then. How's their financial foundation looking? Cash, debt.
Looks really solid. As of the end of March 2025, their cash and cash equivalents position was much stronger, up to $1.889 billion from about $1.5 billion the year prior.
That's a lot of cash on hand. Gives them flexibility.
Absolutely, lots of options. Their inventory levels ticked up slightly to $495.2 million from $474.3 million.
Yeah.
Seems pretty reasonable given the sales growth, probably prepping for future demand.
Okay. And debt.
Zero outstanding borrowings.
Zero debt. That's pretty impressive for a company this size.
It really is. It's a significant advantage. Less financial risk, more freedom to invest or handle any economic bumps in the road.
We mentioned the share buybacks earlier. Can we dig into the specifics of that a bit more? How much did they actually repurchase?
Sure. So just in the fourth quarter, they bought back about 1.8 million shares, spending $266 million.
Okay.
For the whole fiscal year 2025, it was around 3.8 million shares, costing them $567 million.
Wow.
And they didn't stop there. They continued into the new fiscal year, Q1 of 26. As of early May, they'd already bought back another 765,000 shares for $84 million.
That's a serious amount of capital going back to investors.
It absolutely is. And to underscore that commitment, the board approved adding another $2.25 billion to their repurchase authorization.
So the total authorization is now $2.5 billion.
Exactly. It sends a very clear message about focusing on shareholder value.
Okay. The report also included some comments from the CFO. What were the main points he wanted to get across?
He really highlighted a big milestone, Fiscal 25 was their fifth straight year of double-digit growth in both revenue and EPS.
5 years straight. That's consistency.
It is. He even pointed out the compound annual growth rates over those 5 years, 19% for revenue, 32% for EPS. That kind of sustained performance really speaks volumes.
Definitely noteworthy. What else did he emphasize?
Well, he talked about navigating the current, near-term economic uncertainty, being adaptable, disciplined, but still investing in the long-term growth of HOK and UGG.
Balancing act.
Right. And he pointed back to their strong financial position, that big cash pile, as enabling them to keep returning value to shareholders through those buybacks, even with the uncertainty.
Makes sense. Something else I saw was an update to how they report their business segments. Can you break that down?
Yeah, they tweaked their operating segments in Q4.
Yeah.
They now report things under three main headings: UGG, HOKA, and other brands. And that other brands bucket now basically holds Teva, H&U, and Koolaburra. Before, they had a slightly more granular breakdown, I think, including separate wholesale details for the big brands.
So why the change? Just simplification?
Probably partly that, but also likely to give a clearer view of the performance and strategy for the two core giants, UGG and HOK, versus the sort of collection of smaller brands. That might help them and investors focus decision-making and resources more effectively.
Okay, a more strategic view. Got it. So looking forward now, what's their initial guidance for Q1 of the new fiscal year, fiscal 2026?
For that first quarter ending June 30th, 2025, they're expecting net sales between $890 million and $910 million.
Okay.
And diluted EPS is projected between 52 pounds and 67 cents. But important note, that EPS range doesn't include any potential impact from more share repurchases they might do during the quarter.
Right. Buybacks could boost that number. And noticeably, they didn't give guidance for the full fiscal year 2026 this time. Why not?
Yeah, they explicitly said it's because of the ongoing macroeconomic uncertainty, especially around global trade policies.
Ah, okay. So the bigger picture stuff is making it hard to forecast too far out.
Exactly. It shows how even companies performing really well are feeling the impact of that broader economic climate. They mentioned things like general macro conditions, potential tariffs or trade policy shifts, geopolitical tensions, maybe even supply chain issues cropping up again.
So despite a fantastic year, they're being pretty cautious about the immediate future, acknowledging potential headwinds.
Precisely. They're navigating a tricky global environment,
Mm-hmm.
but clearly still believe in the underlying strength and long-term potential, especially of UGG and HOK now.
All right, let's wrap this up. If we boil it all down, what are the absolute key takeaways listeners should have from this deep dive into Deckers?
Well, the main story is definitely major success in fiscal 2025. Record revenue, record earnings,
Driven mainly by.
driven largely by that incredible growth from HOK and also the continued really solid strength of UGG. Financially, they're looking very strong. Lots of cash, no debt, and a clear plan to return cash to shareholders via those big buybacks.
But with a note of caution.
But yes, tempered by awareness of global economic uncertainty. That's why we see the cautious Q1 outlook and no full-year guidance right now. They know things are complex out there.
So for you listening, hopefully, you now have a really solid grasp of Deckers' recent wins, their current position, and what they're signaling about the near future, all without needing to decrypt that full report yourself.
Which leads to, I think, a pretty interesting question to ponder. You've got this amazing HOK growth story,
Yeah.
right? But you've also got these significant global economic question marks.
Yeah.
So what do you think are going to be the biggest opportunities and maybe the biggest hurdles for Deckers in the next few years?
Okay.
How do they keep that brand momentum going strong while navigating such a, well, complicated world stage? Definitely something to think about.